Hi everybody, Coach D here again to talk about put options. Put options are a contract that give the buyer of the put option the right, but not the obligation, to sell an underlying asset at a specified price called the strike price within a specified time period before the expiration date. A put buyer can profit when the underlying asset decreases in price and can be sold at will at the current market value any time before the expiration date. Put options typically give the holder the right to sell 100 shares of the underlying asset. Now, the buyer of a put option, in exchange for the premium, reserves the right to sell the underlying asset at a predetermined price known as the strike price. Now, that can happen anytime on or before the predetermined date known as the expiration date. So again, it's a contract between a buyer and a seller in exchange for premium that gives the buyer the right, but no obligation, to sell the underlying asset at a predetermined price on or before a predetermined date. Now imagine for a moment that that strike price was $50. If the underlying asset price was above $50, that put option would be considered out of the money. If the underlying asset price was below $50, it would make sense that the seller could actually make a profit by selling it at $50. So if it's below that, it's considered in the money. And the general idea here is that the buyer of the put option can profit if the price of the underlying asset falls. And if it falls more than they paid in the premium by expiration, well then they can exercise that option and make a profit. Otherwise, they can sell the option at will any time on or before that expiration date. And that is essentially how a put option works. The strike price minus the premium will give you the break-even point. And if at any point in time the buyer of the put option wishes to sell, they can sell that option.